Imagine walking into a room filled with giant screens, chaotic noise, and flashing red and green numbers. To most people, the stock market looks like an intimidating, high-stakes casino reserved for Wall Street traders in tailored suits. But stripped of the financial jargon, complex charts, and media hype, the stock market is actually surprisingly simple. It isn't a magical money machine, and it isn't a gambling house. It is just a marketplace. No different in basic concept than your local grocery store or a weekend farmer's market, except instead of buying apples or coffee beans, people are buying tiny pieces of real businesses. Today, we are going to pull back the curtain and explain how the stock market actually works, step by step, so you can understand the engine that powers the global economy. Let's start with the absolute foundation. What is a stock? To understand this, picture a local entrepreneur who opens a successful coffee shop called Metro Coffee. The single store is profitable, and the owner wants to open 50 new locations across the region. However, opening 50 shops requires millions of dollars that the owner doesn't currently have. Rather than taking on massive debt from a bank, the owner decides to divide ownership of Metro Coffee into 1 million equal pieces. Each individual piece is called a share of stock. If the owner sells 400,000 of those shares to outside investors to raise cash for expansion, those investors now collectively own 40% of the business. If Metro Coffee expands successfully and profits soar, the entire business becomes more valuable, meaning each individual share is now worth more. If the business fails, the value of those shares drops. That is the core definition of a stock, a legal certificate that proves you own a tiny percentage of a real operating company. So how does a company go from selling shares privately to trading on global exchanges? This transition is called going public, and it happens through an initial public offering, or IPO. When a private business grows to a certain scale, its founders and early private investors often want to raise significant funds to fuel massive long-term growth or sell a portion of their stake for cash. To do this, they hire investment banks to audit the business, evaluate its value, set a starting share price, and list the shares on a public exchange, like the New York Stock Exchange or NASDAQ. You can think of these exchanges as giant, ultra-secure digital matchmaking platforms. The exchanges don't own the stocks themselves. They simply facilitate trades by connecting people who want to buy shares with people who want to sell them. This brings us to the core mechanism that confuses so many beginners. Why do stock prices change every single second? Why is a share worth $30 today, $32 tomorrow, and $28 next week? The short answer is basic supply and demand. The stock market operates as a continuous, real-time auction. Every second of the trading day, millions of investors offer the maximum price they are willing to pay to buy a share, while existing shareholders state the minimum price they are willing to accept to sell. When a company reports strong profits, launches an innovative product, or expands into new markets, buyer demand increases. Because more people want to buy the stock than sell it, sellers can ask for higher prices, driving the stock price up. Conversely, if a company loses money, faces a major scandal, or enters a declining industry, holders rush to sell. With more sellers than buyers, sellers are forced to drop their asking prices to find someone willing to buy, pushing the stock price down. In the short term, stock prices move on headlines, market hype, and human emotion, fear and greed. But over long periods, stock prices almost always follow a business's underlying profitability. Now, how do everyday people actually build wealth through this system? Investors make money in two primary ways: capital gains and dividends. Capital gains happen when you sell a stock for a higher price than you originally paid. If you buy a share of a growing enterprise for $50 and sell it 10 years later for $150, you have made a $100 capital gain. The second way is through dividends. When mature profitable companies earn more cash than they need for day-to-day operations and future growth, they often decide to distribute a portion of those profits directly to their shareholders. Every quarter, they deposit cash payouts straight into the investor's account simply for holding their stock. When investors take those dividend payouts and automatically use them to buy even more shares, they trigger the compounding process where your money generates returns on top of its previous returns. Finally, you will often hear news anchors report that the market went up today or the market crashed. What does that actually mean? The news isn't talking about every single stock in existence. They are referring to market indexes, which are curated baskets of representative stocks used to measure the overall health of the economy. The most famous index is the S&P 500, which tracks 500 of the largest public companies in the United States. Instead of trying to guess which individual company will win or lose, many long-term investors buy index funds. These are funds that automatically purchase small pieces of all 500 companies in the index at once. This creates instant diversification, spreading risk across hundreds of businesses rather than betting everything on a single outcome. To bring it all together, the stock market is not a casino, a scam, or a closed club reserved for the ultra-rich. It is a public marketplace designed to connect growing businesses that need capital with everyday people looking to build wealth over time. When you invest in a stock or an index fund, you aren't just betting on fluctuating numbers on a computer screen. You are buying a direct stake in real human effort, innovation, and global economic productivity. Understanding this basic mechanics is the single most important step in taking control of your financial education.